Hi guys. Hi,
Hello, sir.
hi Parimal and Yash. Yeah, hi. Good evening. So far, how are the classes going on? Okay. You found all of these interesting, useful.
Yes, sir, it was very useful.
Good to know that. Okay, so today we're gonna be starting with some good stuff. Not just Excel. I know. This is my experience. What happens is once we start with Excel, after a point in time, people become frustrated with Excel because they feel that okay, we're just learning functions, but we're not really applying in the real world. And hence, today, what we will be getting into, I would say, more than even research, more than even finance, accounting, if you understand this and really apply in your own finances or in your own personal career, I think would make, if I had to say what effect, uh, which content which we learn till date, whether it be accounting, whether it be technology, whether it be Excel, which is going to have the maximum impact, I feel it's going to be always time value of money, because these are the two most important commodity which is limited, which is time and the value that it creates, right? Because we are in our prime time right now, right? So if you see, if you look at your age currently, you have a long way to go, right? But the long way to go has to have some impact, has to have some outcome to it, right? And that is only possible if you understand what we're going to learn today uh, properly, right? And also try to apply it as soon as possible. All right, so I think we have got some bit of people who are still joining in, and we are also streaming live side by side on YouTube. And okay, so meanwhile, open your Google Classroom, open your portal, and you should see something which I've posted on financial mathematics. Can you see that? Just type in your chat box if you've seen that. Hi, Sunny. Good evening. I've posted content on financial mathematics. Okay, mind you, these are all real content of the main course. Okay, these are not something which you have cut down short or got it just for this webinar workshop. Nothing. It's pure full content. Okay, and that is what was happening initially, where people were asking that only is it just for 5 days, or uh, I mean, will I learn something? Oh yeah, you're gonna learn a lot. Okay, today is the third day. Tomorrow is the second last class, and after that, Saturday will be the last class, and post that it will be the full course, which continues from here itself. Okay, so it does not stop. People who wish to go for the entire 200 hours program will continue receiving content, and people who say, who want to stick around with the free essential thing will be part of the community. All right, but mind you, this content, everything that I'm giving you is from the full course. Nothing is cut short, including my enthusiasm to teach. All right, do confirm once you have the files, and I would want you to download two sheets. One is the loan case, and one is the TVM Excel. And side by side, I have attached some reading material on time value of money and discounting, which you can read side by side as we speak, and also refer it to it at a later stage. Okay, because that's the theory part. I generally tend like to be on Excel most of the time. I don't really like to refer PPT much, but we can refer it to just to confirm what we are saying. Okay, in the Excel, just to confirm once you have the files and you're ready to go. How to access those files? Just right click on that and open in a new tab. As soon as you do that, you should see this download button out here. Okay. All right. Sai says is ready. What about the rest? Okay. Any which case, I will start sharing my Excel, and you can refer to two files. One is the TVM PowerPoint and the Excel. You need to have both open. Okay. Because TVM is where we're going to practice, and the PPT is what we're going to refer. All right, let's start. Now, if you see on your PowerPoint presentation, right? If you go to the second slide, there is a definition of what is time value of money. Okay, so you can read it side by side, and I will try to explain it using my Excel. Okay, so as you can see my Excel out here, okay, what is time value of money, right? So a good perspective, if you would like to understand the perspective of time value of money, think like this. In 2021, what can you buy using 1 lakh? What is the value of 1 lakh, right? So I try to associate with a very common thing that people do with money is to buy electronics. So possibly you could buy a nice high-end iPhone with about 1 lakh, right? The latest one. But what you could have done using the same 1 lakh, maybe about 20 years back. So 20 years back, you would have even be able to buy a 2 BHK flat in a metro city. And look at what has happened in this period. In this period, the value of money has dropped because of the inflation which is coming up. Right? So 10% inflation has eroded the value of money. So what is the expectation in the future? So the expectation in the future is that if 1 lakh today, you're able to buy an iPhone, if the inflation continues at 6%, that means maybe by 2041, you might not be able to buy an iPhone. Maybe you will be able to buy a nice high-end MI phone. Or in other words, what I'm trying to say is that the value of money will keep on dropping, right? So that's one perspective of looking at time value of money, right? Let's go to the next sheet. Okay, why is it so important? Okay, why is it so important? And we're going to derive every formula. Okay, so you don't have to really remember or try to memorize any formula. Let's see why is this so important. Okay, so let's talk about 1 lakh rupees. Okay, what exactly happens between period to period when you invest? Okay, instead of obviously spend money. So let's say you started with 1 lakh. Okay, and let's say between one period, okay, a period that doesn't really have to be year, month, it can be anything. Okay, so between these two periods, let's say you are getting 2%, right? So obviously 1 lakh has increased by 2% and it has become 1 lakh 2,000. You don't have to calculate anything for now. Okay, so chill and relax. So it becomes 1 lakh 2,000. But what actually happens is what we're going to observe here. The power of compounding. Okay. So what happens between these two periods is 1 lakh is the principal. Right? Let's consider that you've invested 1 lakh. So let's call 1 lakh as principal for the first period. So that remains intact. Okay, that is there. But that 1 lakh generates 2%, which is 2000. That's how it became 1 lakh 2000. Right? But after that, what happens? Now let's say, now instead of only 1 lakh being the principal in the first period, now in the second period you've got two principal, which is 1 lakh and 2000. So now these two are your principals, so they're going to remain intact. But now the 1 lakh doesn't stop working, so this 1 lakh generates this 2000, right? And this 2000 generates another 40. Getting it? Now in this period, what happens? All of this remains intact in the next period, right? But now this 1 lakh again generates one more 1 lakh, 2000. This 2000 again generates another 40, right? But you've got another 2040, right? So this 2000 again is going to generate the third 40, and this 40 now generates 0.8. Now imagine this repeating. So this is going to again repeat in the next period, and again, and again, so much so that it becomes difficult to actually fit it in a sheet. Look at till where it goes, right? So this is why somebody really says that if you understand compounding, you will end up making money, okay, for yourself. Or if you do not understand this, then this will happen to you. You'll end up paying for it. Okay. So that's the power of compounding. All right. But what are we trying to do? We are trying to learn, right? So what we're going to do now is, I'm sure most of you have come across formulas like present value, future value. What are all of this? And, especially people who have done CFA or are pursuing CFA have seen formulas, right? Future value is equal to present value. So we're going to derive that, okay? So that you never have to actually remember any of these formulas. They'll come naturally to you, okay? Now, for that sake, what we're going to do is, I want you to observe, okay? Every formula is actually created by observing a factor, right? What is exactly happening, right? So let's see what is happening between these two periods. So we are seeing that 1000 is generating 2000, right? So what do we call 1000, and when is it actually getting invested? Today, right? Because this is year 0, which means present, today, right? So in reality, 1000 or 1 lakh, sorry, is getting invested and it is generating 2000, right? That means if I have to simplify, I can also call that 1 lakh as present value because I'm investing it today, right? And this 1 lakh is generating another 2%, right? So if you see this formula, right, not the formula actually, just how you increase a value. So you tend to increase a value in this fashion. So I'm going to just write a hard-coded formula, 1 lakh into 2% plus 1 lakh. This is what you generally do when you want to derive if a value has increased by a certain percentage, right? Now, if you look at this, this is present value and this is also present value. But what is this? This is rate, right? The rate of compounding. So Let's try to write it in English. So that would mean it would be PV into rate plus PV, right? That is exactly what we are doing here. PV into rate plus PV. And now, if you see this formula, you could actually try to simplify this. And you could also, let's say, try to simplify and write something like this. PV into 1 plus R. Hold on, but this is happening for how many periods? One period, right? So from here to the second period. So that means I could also write it as raised to 1, because one period, it's not going to really make any difference. But after doing this, what are we actually calculating? We are calculating what will be the value in the future, and hence this would be called as future value is equal to PV into 1 plus R raised to 1, or if you had to simplify this even further, you could also write it as n meaning the number of periods, right? Is this clear? There's the future value formula clear? Do confirm. Wonderful. Okay. Now, we could also try to rearrange this formula. All right. For example, if somebody tells us, I know the future value and I would like to find out the present value. So you would just try to rearrange the same formula. So if I had to find out PV, what I would try to do is I would take the second part of the PV, which is 1 plus R raised to n, and I would take it to the left side of the equal to sign. So it would be FV divided by 1 plus R raised to n is equal to, PV, right? And so using the same formula, we've derived two formulas now. And now we're going to go ahead and derive the third formula. If someone says, I know the future value, I know the present value, and I also know how many years it has taken, can you tell me what is the rate of return which I generated over the period? Then what is actually asking us is what is the R, the rate, right? So how could we possibly rearrange this so that we could get the answer? The answer would be very simple. So since this is on the right side, we could take the present value to the left instead now, right? So we could take this to the left of the equal to sign. So the second part of this would look something like this. It would be future value divided by present value, right? And there would be an equal to sign here. And you would be left on the right hand side. What would be left? 1 plus R raised to n, right? But hold on, we need to find R, right? So the question is, how do you take a raised to value to the left? It's pretty simple. What happens is there comes a bracket divided by present value. And since this is raised to n, if it goes to the left hand side, it will become raised to 1 over n. Okay, so it's gone from the right side to the left side. It's just raised to 1 over n when it goes to the left hand side. And you're left with now on the right hand side 1 plus R. And now I need to just find R. So all I'm left with to do with the rearrangement is to take minus 1 to the left hand side, right? So the new formula would be the same, repeat, minus 1, and you would be left with the rate of return. So we basically derived three formulas just by observing on what is happening at each of these compounding steps, right? And this is the three formula: present value, future value, rate, and per. Okay, that is number of periods it is taken. Now, Let's try to apply. Okay, there are also obviously now complications which we will deal with step by step, right? But you could actually solve the same formula. If somebody gives you 1 lakh and he says you're going to make 2% for let's say, how many periods are we talking about here? 6 periods. So you could also do this manually. You could say 1 lakh into 1 plus r, which is 2%, right? So 2% raised to, how many periods are we talking about? 1, 2, 3, 4, 5, 6. 6. So you should get the same answer, right? So what you basically did is used the same observing mechanism and find out the future value. If somebody says, let's do the opposite calculation, you know that 1 lakh has become 1,12,616 over a period of, let's say, 6 years, and somebody says find out the rate of return which I made. Let's try to apply the same thing here. Let's use this formula, right? So is equal to, what is the future value? The future value is this, B9, divided by present value, which is 1 lakh. I like to do it manually first and then talk about functions, okay? Because then we appreciate functions, and the theory tends to become clear forever. Raised to 1 over 6 periods. You have to be very careful with the brackets here, okay? If you skip putting the brackets here, then this will do a very different calculation, okay? And then you will curse me later on saying that this actually does not work. So you have to be very careful with this brackets, that you put the appropriate brackets as per what I'm doing. And -1, right? So that gives you 2%, right? So we use the same thing to find the rate, right? Is this clear? Yeah, I'll do that. Okay. Now we could use functions also for the same thing, right? We could use functions. So let's talk about the functions now. Okay. Now, if somebody says, what is the future value? It's a very simple thing. But you need to just understand one more thing before you start using functions, because you're going to ask me a very common question once I open the function on what is this and what is that. Okay. So this is when we are only doing a single investment. So if you see here, I'm only investing once. So life is very simple. All right. Things tend to become a little more complicated if I am investing in every period, right? And what is the commonality? What is the common trend? What you see out here in this investment that I'm doing again and again, what is that you actually observe which is common across all the 7 periods? What you see here, can anybody notice and let me know? What is the commonality which is repeating itself? Look closely. It's a very simple question. Yes, right? So the amount is same, right? The amount is same in every period, right? Now, can you try to recollect of any daily thing or daily investment related or payment related stuff which tends to repeat itself in every period with the same amount? Okay, any financial transaction which tends to happen every period with the same amount? Can you recollect something there? Yes, right? So SIP, or the systematic investment plan for mutual funds, wherein you create a scheme wherein you're investing, let's say 5,000, 30,000, 25,000 every month, or a loan wherein you're trying to pay EMIs, equated monthly installments, every month, is an example of something that repeats itself in every period with the same amount. Okay. Now, what is that called? Okay. What is that called? Now, you have to be aware whenever we are talking about something that repeats itself in every period, we are talking about from the first period, not from the 0th period. Okay, so anything that happens, even if I put 5,000 in year 0, this would be still called as present value. Okay, but all of this will be called as, I'll just color it, all of this will be called as PMT or payment. Okay, these are pretty common things, which you can see this term being very common across financial calculators also, where you have the PMT button. Okay, so this is what is called as PMT. Okay, but any PMT, even if it is there at year 0, you would treat it as present value. All right, now we can get into functions, because now I have explained you the thing which is going to come up when we use the function. Okay, so let's try to use the same example. Let's say somebody tells us that we're going to invest 1 lakh, okay, for 6 periods at the rate of 2%. What is going to be my future value? So what I could actually do is I could just use the FB function. Okay, just type in equal to and press F and B, future value. And you can see the description of the function, which says returns the future value of investment based on periodic constant payments and constant interest rates, right? So can you see the word constant payments, which is called as PMT, and constant interest rate? That means you cannot really in the function change the interest rates with period. So if you have a situation where you are saying that 2% is not going to be in every period, you can't really do using this function. Okay, so let's open up the function. The first thing it asks us is rate. And what is the rate? 2%. So let's put the 2% there and put a comma. Next thing which is asked is the number of periods. N per means number of periods. All right, and the periods that we have is 6. Right, remember we're talking about periods, we're not talking about years, months. Okay, we're always talking about periods. So periods can be anything, right? PMT, see the same thing that we were discussing. But now tell me, in this example, do we have a PMT or we don't have a PMT? We don't have a PMT because we are just investing once, right? So the PMT in that case, you would put it up as 0. All right. Now, what is it asking next? Present value. Yes, it's always periods for the calculation, Nitish. Yeah. Periods in the sense, see, supposing I say a year and you're doing a monthly calculation. So you would say 12 months. So 12 months would qualify as 12 periods. Okay. Present value, you can see a bracket there, which basically means that if we're talking about investment, then investment has to be negative 1 lakh. Why? Because see this way, whenever you're investing, it is going out of your bank account. It's a cash outflow. All right. So it always will be negative. Present value is always negative. Okay. But if it is a loan, it's exactly opposite, because you're getting the loan, right? So loan, if you take it's a cash inflow. So in that case, present value would be positive. All right. And there's a last thing which is there is the type. Now, what is type? It's what it's asking you is, if we talk about 0, 1, 2, 3, can you see this here? Right. Now, whenever we are doing financial calculations, majority of the times, we are always assuming that it's an ending period calculation. That means 31st March is the ending period. Okay, we never do the calculation from the perspective of 1st March. Okay, and there is an explanation for that, why it is like that, which is covered in the next slide. But a very simple way to understand is that most of the financial calculations are done using the ending period calculation. I can't really explain it theoretically. I will have to use numbers and a chart to show what I mean. But be advised, if there is a beginning period calculation, the situation will tell you it's a beginning period calculation. Otherwise, it is always an ending period calculation. So ending period calculations are denoted by 0. And press enter. And you just use the function to find the future value, right? And in a similar way, if somebody already gives you a future value, let's say they tell you that, okay, some amount of money became 112,616 in 6 years at 2%, then what was the invested amount? Then what are you talking about? You're talking about present value, right? So the function you would use instead in that would not be FV. In that case, it would be PV. So let's use the PV function. So use is equal to PV. And again, if you see the definition of the function, it says that returns the present value of an investment, the total amount that a series of future payments is worth now. But most likely, the data which is asked is pretty constant. Again, it asks for the rate. So we're going to put the rate. It is going to ask us for the number of periods, which we know is 6. Okay. PMT, as discussed previously, there was no PMT before, there's no PMT now. There's no constant investments that are happening, so the PMT is 0. The future value now, though we have, is 1,12,616.24. And type, as I said, most of the calculations will be ending period calculations, which I'll not get into the explanation still. Okay, so that should give me the present value, and it should be 1 lakh. And you can see now that the sign of this present value is negative, which precisely shows us the investment and not, it shows us the cash outflow. Clear? Present value, future value. Good to see some new faces out here, and I suppose a lot of people have come in for the first time today. I hope you were able to see the old recordings. All right, so that's the present value. Now let's use the next function, which is if somebody had given us the present value and future value, they've also given us the and they have given us the number of periods. How do we find the rate of return, right? In a constant environment, right? So let's use the rate function. In that case, you will use the rate function, right? Again, data is similar. So it's asking for the number of periods, which is 6. PMT, again, constant payments are not available. So we're going to take it as 0. PV, we know it was 1 lakh. And the future value, we know is 112,616.24. Type is 0. And now there's a new twist to this. It asks for something called as guess. Okay. Don't worry about that guess unless I'll tell you, I'll just give additional information. When is the guess used? Guess is used when we are trying to do an iterative calculation. Okay. Trial and error method. Okay. If you do not have such a situation when you're doing trial and error method, you can leave that aside and you can just close the function. So it gives you 2%. So that's your rate. All right. So we have learned 3 functions. Okay. PV, FV, and rate. Now just the last part of it, which is how many years does it take? So we basically just have to learn one more function before we jump. So somebody has given us the entire data. Somebody has said 1 lakh becomes 112 at 2%. What are the number of years it has taken for it to happen? So what you're going to do is we're going to use the n per function. It's going to give you the number of periods. Okay, so you have to be very mindful of whether you are doing a yearly calculation or a monthly calculation. Okay, so n per, again, similar data is asked. 2% is the rate. We don't have a PMT, so it's going to be 0. Present value, as was before, was 1 lakh. Future value is 112.616.24, and type is 0. So this should give you the number of periods, whether it's year, month, days, minutes. 6 periods. Okay. So that's how we use the n per function. I have an entire assignment which you will be able to practice this questions on. About 40 questions is what I'm going to release post this class, which you can practice one by one. The first one will be very easy. The second one will obviously be a little challenging. I mean, that would be real application. The first one is just to get a warm up. Okay, so that's 3 functions. Now we understood. Let me just write down PV. We're done with FV. We're done with rate. We're done with N per. We understand PMT. Okay, so we just understand PMT. But let's try to apply PMT now. So you will do this. Okay, so let's say I take a 40 lakhs loan for 30 years at an interest rate of 6.9% compounded monthly. Okay. Now I'll explain you what to do with that. Don't worry. So in this case, what will be the equated monthly installment? Now, let's look at the data. What is the PV? So here we'll first write down all the data which we have. Okay. So we are supposed to find the PMT. So what is the PV? As per this data, what is the PV? Correct. Should it be positive or negative? Positive or negative? Are you sure? Think when you're taking a loan, is it coming into your bank account or is it going out of your bank account? Suddenly all the negatives have become positive. Yeah. So loan at present value will always be positive. Okay. So let's put in the data 40, 100,000, right? It will be positive. The rate, now this is very, you have to be very mindful of what you're doing. Okay. None of in the entire investment industry, finance industry, nobody ever says, 2% monthly, right? They always will present data, whether it's returns data, whether it's the interest rate data, as an annual percentage. Okay. The reason why they do that is so that you don't have to sit down and do the calculation yourself. Okay. So if you go to a bank, they will give you an annual rate figure. They will never, although you're paying the EMI monthly, although you're paying the equated monthly installments monthly, they will never mention it as the compounding figure monthly. Okay. So you have to be mindful of that. So you need to convert 6.9% divided by 12. Why? Because you're going to pay 12 installments, right? In a year. So it's always going to be, the rate is always going to be 6.9% based on what period calculation you do. If we were paying equated quarterly installments, then you would divide this by 4. If we are doing a semi-annual payment, you would be dividing this by 2. right? But the question says equated monthly installments, so it's going to be divided by 12. Okay, and we're going to infer something very interesting at the end also. So in reality, it comes out to be about 5.75%. Okay, sorry, 0.58%. Okay, that's the rate monthly. Now, what is the future value of a loan? The future value of a loan is always zero, because initially when you calculate equated monthly installments, you have to assume that the loan will get repaid at some point in time, right? You cannot say that, oh, I don't really know what the future value is going to be. Then how are we going to calculate, right? Because there will be no end to the calculation. So in order to create an end to the calculation, the future value has to be zero. All right. Now, since we are doing a monthly calculation, we have in our hands about 30 years, right? Since we are doing a monthly calculation, how many months would that be? So that would be 30 multiplied by 12, right? So that would be about 360 periods. Exactly. So 360 periods in our hand, right? And now we're coming back to the calculation. Okay, so this is where we will calculate the EMI. So open up the PMT function. All right. And just like how it was previously, it's the same thing. Only thing is the data we have already calculated. So the rate, just link the rate. Let's link the number of periods. Let's link the present value. Let's link the future value. And always remember, your EMI calculations will always be ending period. Okay, always. So 0. And voila, there you go. That's your equated monthly installment. So next time when you approach a bank, you can calculate your EMIs yourself. In fact, you can actually create your entire loan repayment schedule as well, and possibly try to take a decision whether that's a good idea to do or not. Right? And we'll come to that. We will be creating an entire amortization schedule or a loan which we take. So that's your PMT, right? Now let's do one more version of PMT, but this is more from a investment perspective. This is done, guys. All good here. Any questions here? Okay. If any questions, do let me know. All right. Let's say we will do a calculation now from an investment perspective. Okay. So let's say you want to retire in, this is my common question, 25 years, in another 25 years. Okay. And your current monthly expenses are, let's say, about, since there are people coming from all across the globe, I'm going to keep the calculation in dollar terms. Okay. How much would be a good amount? Let's say $5,000. Okay. Let's, just for calculation sake, okay, let's say your monthly expenses are $5,000, and the inflation expected in 25 years, in the coming to 25 years, will be, let's say, 4%. Okay. The returns you can expect to generate over this 25 years is, let's say, 12%. Okay. How much should you save monthly? So let me just pull up that screen, or maybe let's just wrap the text. Oops. This is a problem of Excel. With the text, you really can't. So I think you can see the question. Can someone give me the answer for this? So you want to retire in 25 years and your current monthly expense is about $5,000 and the inflation expected in the coming 25 years will be 4%. The returns you can expect to generate over the coming years is 12%. How much should you save monthly? That's a real application of foreign investment. Okay. Now, the way to approach this is that this calculation has two parts. You can't really solve it in one go. Okay. The first step should be that you should calculate the future value of the same monthly expenses, maybe 25 years hence. So can somebody quickly tell me what is going to be the future value of $5,000 expenses after 25 years, okay, considering an inflation of 4%. Mind you, the inflation is an annual inflation. It's not a monthly inflation. So you might just overestimate the expenses if you take it as monthly. So your N per is going to be 25. Your present value is going to be 5,000. Okay. And your you just need to find out the future value. So it's a simple future value calculation. Can somebody tell me how many years, what will be the future value of the same $5,000 expenses? It's a simple FE calculation. Okay. Also, I'll just add one more thing to this. You are expected, that's a tough thing to write actually. You're expected to live, let's say, 20 years post. Okay. Is there some way where I can just copy this in a whiteboard maybe? No. Doesn't really copy, but I can take a screenshot of it. Okay. Let's calculate. Is equal to future value. The rate is 4% annually. Okay. N per is 25, PMT is 0, present value is $5,000. All we're trying to find out is the future value of the same expenses 25 years hence. Okay. So the number would come up to be, this would be the monthly expense post 25. So this is the amount of money you would be spending, you would be needing monthly after 25 years after that. Okay. This is dollars, so ignore the currency. I'll just change it into number. So this would be dollars. Oh, okay. Parimal, that's a huge number. I don't know what happened to that. Okay, now that was the first part of the question. We're still solving the first part of the question. Okay, so we are looking at the first. We are first trying to find the requirement. Okay. So this is obviously the monthly expenses that would be needing for another, how many years are we going to live? Look at the question. 20 years, right? So this is the amount of money that we'll be shelling out every month. Okay. Now, I'm going to, you can assume that the returns stay constant even after that. Okay. That's an assumption to make. But even after retirement, let's say his bank account or his investment account still generates that 12%. Okay. So using that, we're going to calculate the present value. Okay. In a timeline, how would it look? Let me show it to you. Okay. This is more well understood if we actually draw a timeline. So we're talking about 25 years, right? So this is how it's going to look. 25 years. I'm just going to zoom out a little. So we are sitting here. This is today. Okay. And today we are spending 5,000 per month. That is what we need. After here, we are saying we would start needing from 26th. Okay. For another 20 years, which is almost 45. So I'll just put a different color to that. This is post-retirement. And this is the pre-retirement. Okay. So pre-retirement, post-retirement. So from here, we would be needing how much? This much. Every month. Okay. Every month. Now, what we're trying to do is we're trying to solve this part first, and then we will enter the green part where is the real work has to be done. Okay. So what we're trying to find out is that at this point, okay, at this point, what should be my portfolio size so that it's able to fund this expense. So in other words, you have to forget about the first part for some time and try to find the present value. Okay. So let's put that concept here. So present value. Now rate my investment portfolio is making how much? 12%. Remember? So we're going to take 12%. However, remember 12% annual. So we have to change that to monthly. How many periods are we talking about? We're talking about 20 years, right? So 20 multiplied by 12 is my number of months that I have. How much do I need monthly? We just calculated that, right? How much was it? 13,329.18, right? So that is the amount of money I would be needing a month, right? Future value, we don't really want to save anything at the end, right? We just want to blow everything up. So the future value is going to be 0, right? And now type is 0. Okay. So 12% is the return we're going to generate from year 26 to 45. Okay. That is the post-retirement phase. How many periods? 20 periods, which is 20 years multiplied by 12 months, which is about 240 months. How much are we going to shell out from our portfolio? We're going to shell out 13,329.18 every month. And hence, what is the present value which we will be needing at year 26 so that we're able to even do this? So it's going to be this much. It's about 12. Let me just decrease the decimal places. Yeah. So that would be about 12,10,548 dollars is what we need at the time of retirement. Okay, so this is going to be our goal. Okay, that's our saving goal. So if we have this money, and our investment portfolio is generating 12% every year, and we fortunately are able to live for 20 years, then our retirement goal, how much we need to save from today, is going to be $12,10,548. That's the first part, is to find out the requirement. Okay, this is the requirement. Now we come to the first part. Is this part clear, guys? The only place where people tend to get confused with this is they try to do it in one go. Never try to do this kind of calculations in one part. You can't really do this in one part. Okay, so you have to practically understand using a timeline. Just like how in the if function yesterday we were going traditional, right, and we were writing it down in a piece of paper or trying to write the logic. The same way, it's a good idea to make a timeline like this and then try to understand. Okay, so now we know the requirement. This is what we need to achieve. Now let's go back to where we are today. We are here today, and we are trying to ask ourselves, how much should we save monthly so that we actually reach that target, right? So what we are trying to ask ourselves, look at from all the functions that we're talking about. We have PV, we have PMT, we have rate, we have future value, right? What exactly are we trying to find out? If I am saying how much should I save every month, which one of these are we trying to find out in the first period? Because present value is 0, we really don't have anything. The future value, we just found out the requirement, right? This is what we need to save. This is what the future value is. The rate is given to us, which is 12% divided by 12, because monthly, right? And I suppose there's nothing else to find out, so it has to be the PMT, which is basically saying that how much should we save monthly, right? So let's go ahead and try to find out what the PMT will be. So the rate is 1%, 12% divided by 12, comma. The number of periods that we have is about 25 years, I suppose. Yes, right. So 25 multiplied by 12 months. The present value is 0. We don't really have any lump sum amount with us today. If we had, we would have put in that amount as a negative value. Let's say if we said that we already have 1 lakh, right, $1 lakh, so we would have put in minus $1 lakh as an available capital. But since we don't have that, we're going to skip that. And what is the target? The target is to reach this value on R29, which is $12 lakh. And hopefully this function is going to tell us how much will we have to save per month. So it's going to be about $644 per month, which we will have to save for about 25 multiplied by 12 months. And also figure out some place where an asset can give us a 12% annualized return. All right. So that was one of the applications. The second application of PMT, which is a little complex version, which I did. I took the liberty to do that. And I will give you an example also to practice. So don't worry about it. But see, these are the real life applications, right? I can just make you do easy stuff. But easy stuff is really not going to help you in the real world. And we have not even done the complexity of, also putting up a question saying that maybe not every period the returns are going to be same. So we have not added that complication still, but we will in the future. All right. So we just did 2 applications. Okay. Now, how good are we till here? Are we okay with all the basic time value of money functions? Let me know. I've got time. How are rest of us doing? Hey Cedric, good evening. I hope you're doing well. I hope I hope I'm able to make you understand. The formula of PMT, yeah, why not? There you go. All right, we good? Okay, now let's try to apply this, okay, and try to see how an amortization schedule works. We'll come to the next sheets in a while, don't worry. I've also given you a second file on a loan case. Can you see that? There's one more Excel available. Just open that. Just trying to add some change. Since we were talking about a loan, let's see how that's done. Come to this sheet. If you don't have the sheet, just go to the portal and download the loan case. Once you have it, just ping me in the chat box that you're ready. Yeah, do we have the files? All right. So what we're going to do is we're going to create an entire amortization schedule. Amortization schedule basically means when you take a loan from the bank, they create an entire repayment schedule. Okay. But we're going to go beyond that, and we're going to answer some of the most critical questions related to time value of money into decision making. Okay. So let's say we have taken a loan of about 10 lakh. All right. So whatever you want to call it, you can call it dollars, you can call it rupees, you can call it whatever currency you want to call it. The rate which is given is 12% annualized, which needs to be compounded monthly. The number of years that we have is 10 years, but since we are paying monthly, it's going to be 120 periods. All right. Yeah, Mitesh, you're free to catch up with me post the class. And we need to calculate the EMI. So can we quickly calculate the PMT and just post your answers on the chat box, and then I'll show you how to create an entire amortization schedule. Quick calculation on the PMT. Be mindful of the conversions, okay? Yeah, Sunny, you need to calculate the EMI. Just quickly calculate the EMI and post your answers quick. Wonderful. That's the correct answer. Anybody else has a different answer maybe? Yeah, just post the answer, Sunny. Okay, wonderful. So most of us have got how to calculate the PMT. All right, so the rate is going to be 12% compounded monthly, right? Remember, you have to be mindful of the conversions. Yes, right? So it has to be 12% divided by 12 because we're doing a monthly calculation. The number of periods is going to be 10 multiplied. Oops, sorry. 12% divided by 12. The number of periods multiplied by 12 because we're doing everything is monthly. The present value of the loan is 10 lakh. It's going to be positive. The future value of a loan is always 0. And the type is always ending period calculation. So this should give us a negative value of the equated monthly invest in payments, right? Which is $14,347.09. Okay, so I hopefully everybody was able to get this answer. If not, just look at what are the numbers that you have put in. Okay, and Mitesh, when you're doing that, do not try to do the hard coding. What you have done is when you have shown me the formula, I can clearly see that you've put in 0.001. I would encourage you to refer values because later on what we could do is we could actually change these numbers and see what happens to the amortization schedule. Okay, so now what happens is if you see here, we have created about 120 rows which are going to be my repayment periods, right? And you can see my table which shows beginning loan, interest, EMI, ending loan, principal, repaid, interest, right? Now you have to understand one thing: the equated monthly installment has two components to it. One is the principal that you try to repay, okay, the principal that you repay the bank, and the other is the cost. So the principal part, you're trying to return the loan. The interest is the cost that you're paying for the loan which you have availed, right? So these two components will always add up to be EMI. Okay, so the 14,347. So if you talk about the 14,347, there is a principal component and there is an interest component. But the beauty of this is that it is never the ratio is never the same. Okay, it will change over the period, and we'll actually do that and see how that actually changes. Okay, so the beginning loan at year 0 is how much? It's 10 lakh, right? So just link it. Make sure you're doing the referencing part. Okay, do not do hard coding. Absolutely not. You will not really see the results. Okay, so is equal to B2, which I've done is the beginning loan, right? Now the interest part. So the interest part is 1 lakh. So select the beginning loan, shift an 8 for the multiplication sign, then click on 12%, put a dollar sign. Remember, please do not forget dollar sign divided by 12 is the interest. Okay, so that's the cost part. That's how the cost part of the loan is calculated in reality. All right, so this will give you out of that EMI of 14,347 in the first month, what is the cost that you're going to pay? So that's about 10,000, right? So 10,000. So out of this 14,347 in the first month, 10,000 is actually the cost, right? So the remaining 4,347 is the principal that you're going to repay for the first month. Okay, and this proportion will always keep on changing. So interest is calculated. Just do it. Just link in this manner. Sunny, what we're trying to do is we're trying to create an amortization schedule, not exactly try to calculate a certain value, right? So there you go. So that's the interest. Link the EMI and put a dollar sign to the EMI because we're going to drag the formula down. Okay, and the EMI, if you see the brackets, that means negative. Okay. Now end loan. Now the ending loan is actually reduced by the principal amount, not the EMI. Okay. So this 10 lakh, okay, has to reduce from the principal repaid, not the interest. Okay. So that means you could also do, what you could also do is just sum up the beginning loan, the interest and the EMI. Why? Because if you see EMI is negative 14,347 and interest is positive 10,000. What is the summation of that? It's going to be negative 4,347. And what is that negative 4,347? That is the principal repaid, right? So that would automatically deduct the principal from the beginning loan. All right. So you could just put up a sum function out here, and that should give you the ending loan. All right. So that's the end loan. Now, what is the principal repaid? It's just as we discussed right now. We could also calculate it this way, just to keep the number positive so that we can actually create a chart at the end. We could do it as beginning minus ending loan. All right. So that should give me the principal, which is actually repaid. And that is 4,347. Okay. And the interest part, just link this. The reason why we're creating the F and the G column is to create a chart, which we will show. Okay. So there you go. Are we done till here? Are we good till here? Do we have the same value still here? Let me know. Okay, good. Now in the next period, okay, so we're just gonna repeat one part of it and the rest is just gonna repeat by itself. Okay, so what we're gonna do is we're just gonna link the end loan. So the ending loan at first period becomes the beginning loan for the second period, right? So we're just gonna link this. Okay, ending loan for the first period becomes the beginning loan for the second period. Press enter, and everything else just repeats itself. The calculation will repeat itself. Okay. Let me know till here if you're done. After this, there is nothing to do. We just have to double click on that square. So let me know till here. If your linkages are correct, you put your dollar signs correctly. Just have a quick check. Okay. Your calculations are absolutely linked. Just confirm. And then all we have to do is we have to select the second row till here, and just double click on that. Can you see that square out there? Can you see the square? Right? Just double click. Okay. And the way to check if our amortization schedule has been made correctly is to just go to the last cell. How do you go to the last cell? It's easy. It's Control and down arrow key. Okay, so just press Control and then press the down arrow key, and you will come to the last cell. So it should be 0 if all calculations has gone as per plan. So do confirm once you have the answer for this. So your ending loan should be 0. All right. Are we all good till here? Okay. I suppose. All right. Now again, if you want to go directly to the first column, just press Control and up arrow key. So we'll come to the first part. Now, the reason why we did all of this was also to do some interesting discussions, okay, about discussions about loan. A lot of people are scared about loans, okay, about debt, and that's what we're trying to ask ourselves a few questions, okay, and also see how this actually turns out in the entire span of the loan. Okay, so what you're going to do now is press Shift and right arrow keys. Okay, so what we're going to do is we're going to select the principal and interest column entirely. So the way to do that is Shift and right arrow keys. Now press Control. So keep the Shift on. Okay, do not leave the Shift. Control and down arrow keys so that you select all the cells. So you select all the cells, and now you press F11. Just press F11. Okay, that's the shortcut key for a chart. So your Excel will automatically create a chart. Now, can anybody interpret this chart? I hope you got the chart, first of all. Yeah. So can anybody explain me what this chart means? Anyone? Okay, you want me to repeat this again? All right. So what you do is just go to the principal and interest column, and first press Shift and right arrow keys to select principal and interest headers, and then press Control Shift down and press F11. Okay, so F11, as soon as you press, you should get this chart. F11, just press F11. After selecting those two columns, just press F11. Yes. So what you see out here is there's the red part, right? The red part is the interest component, right? So as in the entire life of the loan, your interest component is high at the beginning. And then slowly, as you progress with the EMI, your interest payments keep on reducing and your principal component keeps on increasing, right? The EMI doesn't change. That doesn't mean that your EMI is changing. The EMI is same, right? That's why it's called the equated monthly installments. And the way to see that is look here. Okay, your EMI is same, right? But if you see here, initially your interest is higher than principal, right? Because you've got more time for the loan, right? And the value which is left in the loan account is higher, right? And hence the interest is higher. But as your EMI starts getting repaid, you'll see that the principal component starts increasing, right? And your interest component starts reducing, right? Over the period, right? And after a certain time, it's actually purely principal that you're paying. Now, the question to ask you is that if you're talking about, let's say, the 70th period, right? and let's say 70th periods is what we're talking about, 12 months, right? So about sixth year. My question to you is, if you were given an option, if you're given an option to repay the loan, let's say even you have the amount, okay? So let's go to the 60th period. Let's say somewhere around here, okay? Let's say somewhere around here, you had 6,52,793. What would be your decision? Should you repay the loan or should you stick around? Should you repay the loan at 60th period if you had the option, or should you not? Okay, Parimal says yes. Okay, Mitesh also says yes. Anybody else? Sheetal also says yes. Anybody else? And also explain why. Why should you repay? Since you said yes, we should repay, what is the reason why you want to repay? And can you quantify that? So that's where finance has to come in, right? You can't just blindly say that, yes, we have to repay. There has to be a very quantified reason why you should be repaying. If you, I'll tell you one data, okay? If you look at this chart out here, right? Most of the cost which you had to pay by the 60th period, you've already borne. And now is the time for you to actually, enjoy just paying the principal, because you're actually not paying the cost. So why would you repay the loan, right? And second of all, if you are generating higher return than the 1% that you are paying to the bank, why would you take your money from a higher paying asset and repay where your interests are lower, right? So particularly if you talk about India, where the home loan rates are about 6.9%, right? So this is the home loan rate today, right? And let's say we're talking about equity markets or any investments for that matter. If equity markets can give you, let's say, about 15 odd percent, why would you take this money from here and put it here to save 6.9? What is the logic for that? So you're taking an expensive money which you have and you're removing it from your portfolio and you're paying the bank at this period, okay? Why? So there is absolutely no logic to that, right? You should not repay the loan, okay? Unless you are those kind of persons who invest in FD, fixed deposit, or you do not really have an investment plan with you, wherein you are able to beat 6.9%. Even if you're not even making 6.9%, then of course you should repay the loan, because then, I mean, at least you will save the 6.9%. But if you are those sorts who are a disciplined investor and you have an asset where you are actually making money, you should not be repaying the loan. Okay, I have got one more reason why you should not repay the loan. Okay, can anybody think of any other reasons why you should repay the loan, or if somebody else has any other idea why you should not repay the loan? I have one more. Okay, actually I have two more. Okay, so let's say we're talking about a house purchase. I have actually used this example multiple times. Okay, and let's say we're talking about 2016 And the current year is, let's say, about 2021, right? Let's say the value of property, let's say you were looking at a property to buy. And let's say the property, and if you're talking about India, okay, I'm just going to take the Indian value. In India, this would cost somewhere around 70 lakhs in rupee terms. So that would come down somewhere around $1 lakh. Okay. In the conversion terms, that would be $1 lakh. So 70, 100,000, let's say in 2016. Okay. Today, this value is in at least 1.2 crores, which is about almost a 9% compounding every year. Okay. And let's say you took up a loan to purchase the property, and you look at and you funded using at least 85% funding using the home loan. Okay. So let's say you took the home loan, almost 85%. Okay. Or 80%. I mean, let's not take 85%. Let's take a decent number, which is 70%. So this is the home loan that you took. Okay. And this is the equity part, which is your own contribution for buying this property. So this was your 21 lakhs which you put in. Okay. Now what happened? Now in 2021, okay, the home loan obviously is getting repaid across years. Okay. So let's see how much of that. So we're talking about how many years? We're talking about almost 6 years. Yeah, 5 to 6 years. So I'll just do is I'll just put in this value out here. Okay, so the same loan value, I'll just put it up here. Where is that value? Oops. Yeah, it's here. It's in row number 60. Okay. So let me just take this home loan value and let me put it in this table. Okay, and 6.9%, and we're talking about 6 years. Okay, so 6 years is about 60 periods. So this much is left. All right, 29 lakhs. So somewhere around here, we are left with about 29 lakhs of home loan. Okay. And let's say you repay the home loan completely. Okay. Let's say you repaid the loan completely. And what is left after repaying, and you sold off the house also. So you made how much? 90 lakh 92,000, right? Now, let's calculate returns. Okay, you know how to calculate returns? Let's find out the rate. Let's first just calculate the rate of returns from the property appreciation. Okay, how many years are we talking about? We're talking about 6 years. There is no PMT. The present value was 70 lakhs. The future value is 1.2 crores. The type is 0 and nothing. What is the rate of return that you actually made? 9%. Right? Let's try to look at the same returns for the money which you put in. You put in how much? 21 lakhs. And that became 90 lakhs. So let's calculate the rate here. 6 years again. 0 PMT. Present value is 21 lakhs. Future value is 90 lakhs. 0. What happened? So the property just appreciated by about 9.3%, but you ended up making 27.67%. Why? Because of home loan, right? Because of the appreciation that you got because of leverage. Imagine if you had to put in the entire 49.70 lakhs from your pocket, from your equity, you would have just made 9.39%. But since money is cheap, right? And this difference is just by about 3% odd. Look at the difference, right? I mean, home loan is 6.9%, and your value of property appreciation is about 9.3%. Just that 3% can make you such a big difference if you talk about leverage. And this is the only place where the bank tends to give you money, at least in India. Yeah, I'm not even calculated the tax benefits, okay? But just holding the everything else constant, just the returns part also is magnified. This is my first reason for you. Okay. Second is legal. As you keep on collecting assets in your life, there is a risk of losing everything due to disputes. Okay, disputes or legal suits. Somebody can. I mean, nowadays it's a very common thing to get sued for some new reason. Okay, because it's very easy to sue. And one small legal suit can actually put your assets into trouble, because you are as an individual, right? And you have unlimited liability. So if you start putting all your assets on your name only, which is what this is the mentality, most likely it comes from our family, is to put everything in our name, right? The house is in our name, the investment is in our name, everything is in our name, right? But when you take a loan, what is happening is the property is also owned by the bank, right? Because they've given you the loan, until the time you do not repay the principal entirely, the bank papers, the mortgage papers, the property papers tends to be mortgaged with the bank, right? That means they hold the paper. So even if there was some dispute to happen, it's still giving you a layer of protection from somebody who actually comes and sues you, right? Because even if they sue you, they're not going to get everything, right? Because probably just a part of it is what they want to be able to claim against you, right? So that is one second benefit and the third benefit, I think somebody rightly pointed out, is the tax benefits. Wonderful tax benefits to be achieved if you leverage. And I would suggest you to actually do all these calculations before you actually take decisions. Do not blindly, follow what the general people will talk, because general people are unaware of, they don't know how to do PMT calculation, they don't know how to do FE calculation, and they might be doing it in their jobs, but they really don't apply it in their real life. Okay, and there are a lot of financial analysts I know who do not really invest in stocks. So it's not common knowledge, right? So whenever you're taking an investment decision, be sure to calculate it and see if it actually makes some sense before going ahead and blindly following the advice of a financial advisor also. All right, so that's where I would like to end today's class in time value of money. And hopefully it was something which was not just useful for your career, but also for your personal finances. And I could just go ahead talking about time value of money forever, because there are so many applications we can talk about. And I would be happy if somebody could post such practical application confusions, doubts, which we can actually solve it in the class. Okay, whatever your question is. And that would actually increase our learning. So if anybody has any questions, I would like to answer that. Otherwise, we can call it a day and we can meet up tomorrow again. Tomorrow, the second last day. And after that, it's going to be the final day on Saturday. And that's where the essential course will end and the full course will begin. All right, guys. Any questions? Any questions, please post, or else we will call it a day. All right, if no questions, if everything was pretty understandable, or I suppose if it was confusing, I'm really sorry for that. Maybe I will be able to help you with the doubts post-class. All right. So thank you guys for joining in. Have a good night, and I'll hope to see you tomorrow again at 7 p.m. Thank you. Bye bye.